Tom Lee, head of research at Fundstrat and chief investment officer of Fundstrat Capital, just made another bold prediction for the stock market. He believes the S&P 500 could climb as high as 8,800 this year, driven by stronger than expected earnings and improving valuations. In this video, I'll show you Tom Lee's interview on CNBC, then I'll break down exactly what he meant and give you my own reaction to his bullish outlook. And finally, I'll reveal 3 stocks that I believe are great long-term buys and holds right now. Let's hear what Tom Lee has to say.
Great time to check in with Tom Lee, head of research at Fundstrat, chief investment officer of Fundstrat Capital, as well as a CNBC contributor. You weren't really impressed with June that much in terms of the averages kind of stalling out, and you expect July to be better as valuations are more reasonable and sentiment is not crazy bullish. Does that sum things up?
Yeah. I mean, in July, we're going to get Q2 earnings.
Right.
And in the first quarter, earnings came in way better than expected. And so the market's PE is actually lower now than it was in January by 1 point, 1 full turn. And I think second quarter earnings are going to surprise to the upside again. So the market's going to get cheaper again. And that means there's room for PE to expand. So I think July is going to be a stronger month for stocks.
8,000 is doable this year.
Yes.
On the S&P.
Yeah, and that's, because 8,000 would be roughly 20 times 2027 earnings of 400. I think that's a low estimate. I think the PE multiple could be 22 or better, so that would be, even 84, 8,800 kind of would be the upside into year-end. But I do think between now and year-end there should be, something that might feel like a bear market too. Not in July, but maybe, between August and October.
Why not in July?
Well, I think for the things Joe cited, that, June wasn't a great month. And I think there are a lot of fund managers trailing the benchmark this year. Only 23% of fund managers are beating the large cap growth index. That's the lowest number in almost 5 years. So I think there's going to be a lot of dip buying this month.
What do you mean it feels like a bear market? Does it go down 20%?
It might.
And what average? Are we talking about the NASDAQ or the S&P?
I think both. This year, the February to April decline felt like a bear market, and that was only 7%. But I think, in later this year, we have a few things that will test the market. One is the market is going to test the new Fed because he has a new framework and a new way to look at inflation, and we know that there's going to be a gradual unlock of the SpaceX shares, and that's a headwind. And I do think, there is going to be a cumulative shortage of petroleum products, so that's a headwind. And I think margin debt's kind of high. So I think 4 things that could unravel in a way that might feel like a bear market.
Right at the beginning of the interview, Tom Lee explains why he was not particularly impressed with June's market action. The major averages essentially stalled, and the market did not make the kind of explosive move that many investors had expected. However, instead of seeing that as a negative sign, he actually sees it as a positive development. His reasoning is interesting. He believes that because stocks paused and earnings continued to improve, valuations have actually become more reasonable. In other words, the market did not become more expensive despite trading near record highs. Earnings have been catching up to prices. This is something many investors often overlook. They hear that the market is at all-time highs and automatically assume stocks are overpriced. But if corporate profits are growing faster than stock prices, then valuations can actually become cheaper over time. Tom Lee points out that after first quarter earnings came in much better than expected, the price-to-earnings ratio of the market actually declined compared to where it was earlier in the year. That's an important point because valuation is one of the biggest arguments used by market bears. According to Lee, the market's valuation multiple has come down by more than 1 full turn compared to January. That means companies have been generating earnings at a faster pace than many analysts anticipated. And now he believes the exact same thing could happen again during second quarter earnings season. This is really the heart of his bullish thesis. If earnings once again surprise to the upside, then the market becomes even cheaper on a valuation basis. That creates room for investors to bid stocks higher and for price-to-earnings multiples to expand. In simple terms, if companies continue making more money than expected, stock prices may have further room to climb. Personally, I think this is one of the strongest arguments for staying invested right now. Over the last few years, analysts have consistently underestimated the strength of corporate earnings, especially among technology companies. Every time investors begin worrying about valuations, earnings growth ends up bailing the market out. And when you think about it, there are legitimate reasons why earnings could remain strong. Artificial intelligence spending is exploding. Cloud computing demand remains robust. Companies continue investing heavily in digital infrastructure. Productivity improvements from AI could also begin boosting profit margins in ways that Wall Street is only starting to appreciate. Tom Lee then makes his most eye-catching prediction of the interview. He says the S&P 500 reaching 8,000 this year is absolutely doable. That is a massive call. To put that into perspective, reaching 8,000 would require another meaningful move higher from current levels. But Lee does not stop there. He actually suggests that if investors assign a higher valuation multiple to the market, then the S&P could potentially move toward 8,400 or even 8,800 by year-end. That is an incredibly bullish scenario. Now, whether you agree with those exact targets or not, I think the underlying message is what matters most. Tom Lee believes we are still in a secular bull market. He believes the economy is stronger than people think, earnings are stronger than expected, and investors continue underestimating the power of this bull cycle. And honestly, history shows that some of the biggest market advances happen when the majority of investors remain skeptical. That brings us to another fascinating point he made during the interview. He said investor sentiment is not excessively bullish. This might surprise a lot of people because financial media often creates the impression that everyone is euphoric. But according to Lee, there are still plenty of fund managers who are lagging behind the market. In fact, he points out that only 23% of fund managers are outperforming the large cap growth index. That is apparently the lowest number in almost 5 years. Think about what that means. Professional investors are underperforming. Many of them are underinvested. Many have been waiting for a correction that never came. Many are still skeptical of the rally. And when professional investors are trailing the benchmark, there is enormous pressure to chase performance. Nobody wants to finish the year badly underperforming their peers. That creates what Tom Lee refers to as dip buying pressure. Every pullback becomes an opportunity because fund managers who missed the rally are eager to get back into the market. Personally, I think this is a very important dynamic that retail investors should understand. Market corrections often do not last very long when there is a huge amount of cash waiting on the sidelines. Investors who are underexposed to stocks become buyers every time prices decline. That can make sell-offs surprisingly short-lived. But then Tom Lee shifts gears and introduces a note of caution. Even though he remains bullish on July and bullish on the year overall, he says investors should still prepare for something that might feel like a bear market between August and October. That statement probably caught everyone's attention. After all, how can someone be extremely bullish and also warn about a potential bear market experience? The answer is that bull markets are rarely smooth. They are filled with corrections. They are filled with periods of fear. They are filled with violent pullbacks that make investors question everything. Tom Lee even points out that the decline between February and April felt like a bear market to many investors despite the fact that the market only fell around 7%. That's a great reminder that investor psychology often matters more than percentages. A 10% correction can feel devastating when everyone is positioned for stocks to keep going up. A 7% decline can feel like the end of the world if it happens quickly enough. Lee says several factors could test the market later this year. One of those factors is the Federal Reserve. The market will continue analyzing every move made by the Fed and trying to understand its evolving framework on inflation and interest rates. Monetary policy remains one of the biggest drivers of market sentiment. If investors begin worrying that inflation is reaccelerating or that interest rates could remain higher for longer, stocks could experience significant volatility. Another issue he mentions is the gradual unlocking of SpaceX shares. This is an interesting point because major liquidity events can sometimes create unexpected ripple effects throughout financial markets. Whenever large amounts of capital become available or change hands, it can influence investor behavior, valuations, and risk appetite. More broadly, I think Tom Lee's warning is really about expectations. The market has had an incredible run. At some point there will be a shakeout. At some point there will be headlines screaming that the bull market is over. At some point fear will return. The real question is whether that decline represents the beginning of a long-lasting bear market or simply another correction within an ongoing bull market. Tom Lee clearly falls into the second camp. He believes any major pullback later this year would ultimately create another buying opportunity rather than signal the end of the bull market. And I have to admit, there is a lot of historical evidence supporting that view. During powerful secular bull markets, corrections are normal, they are painful, they feel scary in real time, but they often end up being opportunities for long-term investors. The biggest mistake investors can make is confusing a correction with a permanent change in the market's direction. That does not mean investors should ignore risk. It does not mean stocks only go up. But it does mean that having a long-term framework is critical. Tom Lee's message seems to be this: enjoy the strength in July, pay attention to earnings, understand that valuations may not be as stretched as many people think, but also be mentally prepared for turbulence later in the year. Because if a correction arrives, investors who are prepared emotionally and financially may be the ones who benefit the most. Now, let's dive in and talk about 3 incredible stocks that are built to thrive for years, maybe even decades, thanks to some of the most powerful trends shaping the future of healthcare and innovation. The first company on our list is Johnson & Johnson, ticker symbol J&J. When most people hear the name Johnson & Johnson, they think of a healthcare giant that has been around forever. But what many investors fail to appreciate is just how powerful this business has become after its recent transformation. In 2023, Johnson & Johnson spun off its consumer health business into a separate company, allowing management to focus entirely on its 2 highest-margin businesses, innovative medicine and medical technology. That move made the company leaner, more focused, and arguably even more attractive as a long-term investment. This is the kind of company I would describe as a set-it-and-forget-it stock. Why? Because healthcare demand never really goes away. People will continue needing medications, surgical procedures, and advanced medical technologies regardless of whether the economy is booming or slowing down. That creates an incredibly durable business model. And Johnson & Johnson has something even more important than stability. It has innovation. The company spends enormous amounts of money every year on research and development. In the first quarter alone, Johnson & Johnson invested more than $3.5 billion into research and development. Think about that for a moment. Very few companies on Earth have the financial strength to invest billions of dollars every single quarter just to build their future pipeline. This enormous investment is one of the reasons Johnson & Johnson has remained a healthcare powerhouse for so many decades. The pharmaceutical industry is constantly dealing with patent expirations. A blockbuster drug eventually loses exclusivity, competitors enter the market, and revenue starts declining. Smaller companies can struggle to recover from these patent cliffs. Johnson & Johnson is different. Its massive research budget continuously creates new products and therapies that help replace aging revenue streams. This constant cycle of innovation is one of the biggest reasons the company remains such a strong long-term investment. The company's newest launches include the plaque psoriasis treatment Icotide and its integrated cardiac ablation platform called the Thermocool SmartTouch SF catheter. These products represent future growth opportunities that could contribute meaningfully to revenue in the coming years, and the financial results show that the company is executing extremely well. During the first quarter, Johnson & Johnson generated $24.1 billion in revenue, representing growth of nearly 10% year over year. Adjusted earnings per share came in at $2.70, beating Wall Street expectations. Even more impressive, management raised its full-year outlook and now expects annual sales of between $99.7 billion and $100.7 billion. That's an enormous amount of revenue. The company also expects adjusted earnings per share to increase by more than 7% at the midpoint of its guidance. These are not the numbers of a struggling healthcare company. These are the numbers of a business that continues to grow despite already operating at an incredible scale. Another reason I like Johnson & Johnson is its balance sheet. The company ended the quarter with more than $22 billion in cash and marketable securities. That kind of financial flexibility gives management tremendous options. It can invest in research, acquire new technologies, repurchase shares, and continue rewarding shareholders through dividends. Speaking of dividends, this is where Johnson & Johnson truly separates itself from many other companies. The company has increased its dividend for 64 consecutive years. Think about how remarkable that is. Johnson & Johnson has raised its dividend through recessions, financial crises, market crashes, inflationary periods, and multiple economic cycles. Very few companies in the world can match that kind of consistency. That incredible track record makes Johnson & Johnson a dividend king, a title reserved for companies that have increased their dividends for at least 50 consecutive years. For long-term investors, this matters, because a growing dividend does more than simply provide income. it reflects the strength of the business. Companies cannot raise their dividends year after year unless they consistently generate cash and manage their operations effectively. In my opinion, Johnson & Johnson represents the kind of stock that allows investors to sleep well at night. It may not be the fastest growing company in the market. It may not double overnight. But if your goal is to build wealth steadily over many years while collecting a growing stream of income, this company deserves serious consideration. Its combination of global scale, powerful brands, innovative therapies, massive research spending, and exceptional financial strength creates a business that can continue thriving for decades. And in a market where many investors chase the newest trends and hottest stocks, sometimes the best investments are the companies that quietly execute year after year while steadily compounding shareholder value. Johnson & Johnson has been doing exactly that for generations, and there is a very strong case that it can continue doing so well into the future. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Our second stock is Abbott Laboratories, ticker symbol ABT. If Johnson & Johnson is known for its scale and research engine, then Abbott's greatest strength is something equally powerful, and that's diversification. Abbott is one of the most balanced healthcare companies in the world. The company operates across 4 major businesses, including medical devices, diagnostics, nutrition, and established pharmaceuticals. That means it isn't dependent on one blockbuster product or one particular segment of the healthcare industry. And for long-term investors, that kind of diversification can be incredibly valuable, because when one part of the business slows down, another part often picks up the slack. That's exactly what happened recently. In the first quarter, Abbott saw weakness in its nutrition segment, but growth in its medical devices, diagnostics, and established pharmaceuticals businesses more than made up for it. That's the beauty of a diversified business model. The company isn't relying on one product to carry the entire organization. Instead, it has multiple engines of growth working simultaneously, and one of those engines has been absolutely incredible. Abbott's medical device business continues to benefit from strong demand for its diabetes and cardiovascular products. The company has become a leader in continuous glucose monitoring through its Freestyle Libre system, one of the most important innovations in diabetes management over the last decade. The number of people living with diabetes continues to rise around the world. Millions of people need better tools to monitor and manage their condition. Abbott recognized that opportunity early and built a product that has become a major growth driver for the company. This is one of the reasons I think Abbott is such an attractive long-term investment. The company is positioned right at the intersection of several powerful healthcare trends. People are living longer, chronic diseases are becoming more common, healthcare spending continues rising across the globe, and demand for advanced medical technologies keeps growing. Abbott has products and services that address all of those trends. Financially, the company is also delivering impressive results. During the first quarter, Abbott generated $11.2 billion in sales, representing growth of nearly 8% compared to the previous year. Adjusted earnings per share came in at $1.15, which was also a solid increase from the prior year. Management expects full-year revenue growth between 6.5% and 7.5% and projects adjusted earnings per share between $5.38 and $5.58. For a company of Abbott's size, those growth numbers are extremely respectable. But management isn't simply relying on existing products to fuel future growth. The company recently made a major strategic move through its $21 billion acquisition of Exact Sciences. This deal could significantly strengthen Abbott's position in cancer screening and precision oncology diagnostics. Cancer remains one of the biggest healthcare challenges facing the world. Early detection and precision medicine are becoming increasingly important, and Abbott clearly wants to be a major player in these areas. I actually think this acquisition could end up being one of the company's most important long-term growth catalysts. Healthcare is moving toward more personalized medicine and better diagnostic tools. Companies that can provide doctors and patients with more accurate information are likely to benefit tremendously over the coming decades. Abbott understands this trend and is positioning itself accordingly. Another thing I appreciate about Abbott is its ability to consistently generate cash. Strong cash flow gives management the flexibility to invest in future growth opportunities while also rewarding shareholders. And shareholders have certainly been rewarded. Abbott has increased its dividend for 54 consecutive years. That places it among an elite group of dividend kings. Even more impressive, the company recently increased its dividend by nearly 7%. Again, this is not something companies do unless they have confidence in the future strength of their business. A rising dividend is often one of the clearest signs that management expects cash flow and earnings to continue growing. For long-term investors who value stability and income, that's a powerful signal. Personally, I think Abbott is one of those companies that doesn't always get the attention it deserves. It doesn't generate the excitement of some technology companies. It rarely becomes the center of Wall Street headlines. But sometimes the best investments are businesses that quietly execute year after year while benefiting from long-lasting trends that are almost impossible to stop. Healthcare demand is not going away. The need for better diagnostics is not going away. The need for diabetes management solutions is not going away. And the demand for innovative medical technologies is only likely to increase as populations age around the world. Abbott has built a business that touches all of these areas. That creates a very attractive setup for patient investors. The company has diversity, financial strength, recurring demand, and multiple growth drivers that could continue generating value for many years. And that's exactly the type of business I like to own for the long haul. This video was brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Our third and final stock is United Health Group, ticker symbol UNH. If the first two companies on our list make medicines and medical devices, United Health sits in an entirely different position within the healthcare ecosystem. Instead of betting on which company develops the next breakthrough drug or the next medical device, United Health allows investors to own the company that helps manage the flow of money across the entire healthcare system. And that's a very powerful position to be in. United Health is the largest private health insurer in the United States. The company serves millions of people and plays a critical role in connecting patients, healthcare providers, pharmacies, and employers. But what really makes this company special is something many investors don't fully appreciate. United Health is much more than an insurance company. Its real advantage comes from its dual-engine business model. The company operates through its traditional insurance business, United Healthcare, while also owning its massive Optum division. Optum provides healthcare services, pharmacy benefits management, technology solutions, and data analytics. This creates one of the most powerful competitive advantages in the entire healthcare industry. Think about it this way. United Health doesn't simply insure patients. Through Optum, it can also help manage those patients' prescriptions, provide healthcare services, and use its massive data capabilities to improve outcomes and reduce costs. This vertical integration allows the company to capture value across multiple parts of the healthcare delivery chain. Very few healthcare companies have that kind of scale and reach, and that's one of the reasons United Health has become such a dominant force. Healthcare spending in America continues to rise every single year. As the population ages and healthcare needs increase, companies that sit at the center of this ecosystem are positioned to benefit. United Health is one of those companies. Financially, the business remains enormous. During the first quarter, United Health generated an incredible $111.7 billion in revenue. Let that number sink in for a moment. The company produced more than $100 billion in revenue in just 3 months. Its United Healthcare segment alone generated $86.3 billion in revenue. Very few companies in any industry can match this level of scale. Earnings per share came in at $6.90. Management also expects full-year earnings per share of more than $17.35, representing growth of at least 31%. That's a substantial increase and shows that management remains confident about the company's future. Another thing that stands out about United Health is its ability to generate cash. During the first quarter, the company produced $8.9 billion in free cash flow. That's approximately 1.4 times its net income. Strong free cash flow is incredibly important because it gives management the flexibility to invest in growth initiatives, strengthen the balance sheet, make acquisitions, and continue rewarding shareholders. And while United Health doesn't have the same lengthy dividend history as Johnson & Johnson or Abbott, it has still increased its dividend for 17 consecutive years. Its dividend yield is also comparable to those of the other companies we've discussed. What's even more impressive is the pace of those increases. Over the past decade, United Health has grown its dividend at a faster rate than many of its peers. For long-term investors, that combination of earnings growth and dividend growth can be extremely powerful. Personally, I think one of the most attractive aspects of United Health is its ability to adapt. Healthcare is changing rapidly. Technology is becoming increasingly important. Data analytics are becoming essential. Healthcare providers are looking for ways to improve outcomes while controlling costs. United Health is positioned right in the middle of all of these trends. Its Optum business gives the company exposure to some of the fastest-growing areas of healthcare, and because it already has massive scale, the company can continue expanding these businesses while benefiting from significant competitive advantages. Another point worth mentioning is resilience. Healthcare spending tends to be much less cyclical than many other industries. People still need healthcare regardless of what the economy is doing. That makes businesses like United Health particularly attractive during uncertain economic periods. Investors are often searching for companies that can perform well through different market environments. United Health has shown that it can do exactly that. Now, no company is perfect. Healthcare is a heavily regulated industry, and changes in government policy can create challenges. Cost pressures can also impact profitability. But when you're evaluating a long-term investment, it's important to focus on whether the company has the scale, financial strength, and competitive advantages to navigate those challenges. I believe United Health does. In many ways, this company represents a toll booth on the healthcare system. As healthcare spending grows over time, United Health has the opportunity to continue participating in that growth through multiple business segments. And that's exactly the kind of business model long-term investors should pay attention to. So when you step back and look at all three companies we've discussed today, a common theme starts to emerge. These are not speculative businesses. These are not companies that depend on hype. They are large, profitable enterprises that generate substantial cash flows and have proven their ability to adapt and grow over long periods of time. Johnson & Johnson brings world-class research and development, a fortress balance sheet, and one of the most impressive dividend records in corporate America. Abbott Laboratories offers extraordinary diversification and exposure to several long-term healthcare trends, including diabetes care, diagnostics, and medical technology. United Health Group gives investors a unique opportunity to participate in the growing healthcare economy through one of the most integrated and dominant business models in the industry. All three companies also provide something investors often overlook: a margin of safety. Their businesses are diversified, their products and services remain essential, and their long histories show that they can navigate difficult economic periods while continuing to reward shareholders. And perhaps most importantly, all three companies continue creating new opportunities for growth. Johnson & Johnson keeps investing billions into developing new therapies and technologies. Abbott continues expanding through innovation and strategic acquisitions. United Health keeps leveraging the power of data, healthcare services, and vertical integration. That's why these businesses continue to deserve a place on the watch lists of long-term investors. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which of these three healthcare giants do you think has the biggest long-term advantage? Is it Johnson & Johnson's innovation engine, Abbott's diversified business model, or United Health's massive healthcare ecosystem? Let me know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.